Mastering Your Money, A Guide to Personal Financial Planning. Chapter 4, Investing for Wealth Creation. 4.1. Introduction to various investment options: stocks, bonds, real estate, etc. Sure, I can provide a brief introduction to various investment options. Here are 3 commonly known investment options. 1. Stocks. Stocks represent ownership in publicly traded companies. When you buy shares of stock, you become a partial owner of the company. Stock prices can fluctuate based on market conditions, company performance, and investor sentiment. Stocks have the potential for higher returns but also come with higher risk. 2. Bonds. Bonds are fixed income securities issued by governments, municipalities, and corporations to raise capital. When you invest in bonds, you are essentially lending money to the issuer, in exchange for periodic interest payments and the return of your principal amount at maturity. Bonds are generally considered less risky than stocks, but offer lower potential returns. 3. Real estate. Real estate investing involves purchasing properties for the purpose of generating income or appreciation. It can include residential, commercial, or industrial properties. Real estate investments can provide rental income and potential value appreciation over time. However, they may require significant initial capital, entail property management responsibilities, and be subject to market fluctuations. It's important to remember that each investment option comes with its own risks, rewards, and considerations. It is advisable to research further, consult with a financial advisor, and understand your individual investment goals before making any investment decisions. 4.2. Risk Tolerance Assessment. Assessing your risk tolerance is an important step in determining the types of investments that align with your financial goals and comfort level. Here are a few key factors to consider when assessing your risk tolerance. 1. Time horizon. Consider the length of time you plan to invest your money. Longer time horizons generally allow for greater risk-taking due to the potential to ride out short-term market fluctuations. 2. Financial goals. Evaluate your investment objectives. Are you investing for short-term goals, such as a down payment on a house, or for long-term goals, such as retirement? Understanding your goals can help determine the level of risk you are willing to take. 3. Investment knowledge. Assess your knowledge and understanding of different investment options. Riskier investments may require more knowledge and expertise to navigate effectively. 4. Risk capacity. Evaluate your financial circumstances, including income, expenses, and overall financial stability. Assessing your financial capacity to absorb potential losses can help determine your risk tolerance. 5. Emotional resilience. Consider how comfortable you are with fluctuations in investment values and the potential for losses. Some investors may be more emotionally resilient and able to tolerate higher levels of risk, while others may prefer more stability. It's important to strike a balance between risk and reward that aligns with your individual circumstances and comfort level. Remember, risk tolerance can change over time, so it's crucial to regularly reassess and adjust your investment strategy accordingly. Consider consulting with a financial advisor for a more comprehensive risk assessment tailored to your specific situation. 4.3. Long-term versus short-term investment strategies. Long-term and short-term investment strategies are two approaches to investing that differ in their time horizon and objectives. Let's explore the differences between them. Long-term investment strategies involve holding investments for an extended period, typically around 5 years or more. The purpose of long-term investing is to build wealth gradually over time. Investors who employ this strategy focus on fundamental analysis, considering factors such as company performance, market trends, and economic conditions. They often invest in assets such as stocks, bonds, real estate, and mutual funds. One primary benefit of long-term investing is the potential for compounding returns. By allowing investments to grow over a longer period, investors can take advantage of market fluctuations and benefit from overall market growth. Long-term investors can also weather short-term market volatility, as they are less concerned with day-to-day price movements. On the other hand, short-term investment strategies involve buying and selling assets within a shorter time frame, usually less than a year. Common short-term investment approaches include day trading, swing trading, and market timing. Short-term traders rely on technical analysis, patterns, and short-term market trends to make quick profits. Short-term investing can provide opportunities for active traders to capitalize on short-lived market inefficiencies and take advantage of price fluctuations. However, it also carries higher risks due to market volatility and unpredictability. Successful short-term trading requires careful decision-making, timing, and thorough knowledge of the market. In summary, long-term investment strategies prioritize gradual wealth building over an extended period, aiming to take advantage of compounding returns and market growth. Short-term investment strategies, on the other hand, involve more frequent buying and selling of assets within a shorter time period, seeking immediate profits from short-term market fluctuations. The choice between the two depends on individual goals, risk tolerance, investment expertise, and time commitments. It's often recommended to have a diversified investment portfolio that balances both long-term and short-term strategies to mitigate risks and maximize returns. For point 4, diversification and asset allocation. Diversification and asset allocation are investment strategies used to manage risk and optimize returns in a portfolio. Diversification involves spreading investments across different asset classes such as stocks, bonds, real estate, etc., industries, regions, and even currencies. By diversifying, you reduce the risk of having all your investments concentrated in a single asset or sector. This way, if one investment performs poorly, others in the portfolio offset those losses and provide more stable returns. Asset allocation, on the other hand, refers to the process of assigning a specific percentage of your investment portfolio to different asset classes based on your financial goals, risk tolerance, and time horizon. The goal is to create a balanced portfolio that aligns with your objectives. The key benefits of diversification and asset allocation include 1. Risk reduction. By spreading investments across various assets, you can minimize the impact of a single investment's poor performance on your overall portfolio. 2. Enhanced returns. Diversification and asset allocation can potentially optimize returns by capitalizing on different assets' growth potential over time and reducing vulnerability to market fluctuations. 3. Preservation of capital. By diversifying, you can reduce the risk of capital loss if one asset or sector experiences a downturn. 4. Increased opportunity for growth. Investing in multiple asset classes increases the likelihood of benefiting from the growth potential of different sectors and regions. To effectively implement these strategies, it's recommended to assess your risk tolerance, investment goals, and time horizon. Consulting with a financial advisor may be beneficial to design a suitable diversification and asset allocation plan tailored to your specific needs.